Just let people in. Okay. Okay. All right, let's take a red time. Let's go ahead and get started. Just give it a moment for people to join us. It takes a minute for Zoom to let everyone in, and then we'll get started momentarily. All right, looks like great time, so let's go ahead and get ready. Thank you everyone for joining us for the Around the Valuation World International for September 25th, 2023. My name is Chin Chun, and I'm with NACVA and the Consultants Training Institute. Before we get started today, I wanted to go over a few housekeeping items. First, to obtain CP credit, you must answer all the poll questions that pop up on your screen during the webinar. CP is available to AVW International subscribers. There is a link in the material if you do want to obtain the subscription to get CP credit to watch this. If you have any questions during the webinar today, please use the Q&A option in Zoom to ask the presenter a question. If you have any technical questions or questions about NACVA, please feel free to reach out to me in chat and I can assist you with that. On our screen right now are the technical editors for the show. Today we have Wolfgang Nies, who is joining us. We also have Andrew Newman, Pratik Shah, and Brian Jones. The lineup today is Dr. Bennet Kpentey, who will be talking about how free is the risk-free rate. And then before we start with that, I just want to go over a few news items. First, we just announced the agenda for our 2023 Business Valuation and Financial Litigation Super Conference, which will be held in Fort Lauderdale, Florida, December 14th to the 15th of this year. In your material, you have the registration links if you want to register in person and join us in Fort Lauderdale, or you can join us virtually by clicking on the virtual registration link. If you purchase a subscription or register prior to September 3rd, there is an additional discount of $200. So, all right, with that, I'm going to turn the time over to Wolfgang, who will get us started with the presentation.
Yeah, thank you, Chanda. A warm welcome to everybody from Europe. It's a pleasure for me to introduce Dr. Bennet Kpentey. He's strategy and financial consultant, credential business valuation professional with over 27 years experience. I met Bennet 18, 19 years ago because he's also the founder and founder of the African Association of Certified Evaluators and Analysts, and he runs the chapter in Africa. He has supported several M&A transactions through business valuation, due diligence, investment appraisals, and feasibility studies. He is chief executive and lead consultant of his company Cynics Consult, a management and financial consulting firm in Ghana. He's also part-time lecturer in strategic management at the University of Ghana Business School, as well as the Graduate Institute in Geneva in Switzerland. And he runs and founds the website valuepedia.com, the first online business valuation lexicon with over 4 million hits in the last 2 years. He is a doctor of business administration from the Walton University in Minneapolis, and he has a lot of other credentials as well. Again, it's a pleasure for me to talk about how free is the risk-free rate. That's an exciting question, especially when it feels like the whole globe has become riskier over the last years. So let's turn to the topic, and I will hand over to Africa, Bennet, and hope you can hear me now. Yep. You can share your screen and we can start with the topic. Thank you.
Thank you very much, Wolfgang. And thank you very much, Shonda. Greetings to all of you, business valuation community from all over the globe. Can you all hear me?
Yes.
All right, excellent. Yeah, so the topic for today, as has been shared by the team at HQ, Shonda and Wolfgang, is on the risk-free rate. Over the past couple of years, I have been asking questions as to the notion that the world has a universal risk-free rate. And this is very important for accountants, finance professionals, investment analysts, and also for us as business evaluators, because we depend on risk-free rate, especially when we are applying methods under the income approach. So sometime last year, 2022, even though I was aware that some countries and the governments of some countries have defaulted in honoring their commitments on treasuries and also government bonds at maturity, it never hit me till Ghana government defaulted in honoring treasury bill and bonds that matured after 65 years of not failing. So I decided to take up the issue once again and check across the globe what governments have been doing with their commitment to treasuries and also to long-term bonds. So the essence of the presentation today is to give us an opportunity to reflect on what we call the risk-free rate, which we apply in our valuation, and also to reflect on the fact that given all what has happened in the world's economic and financial system, whether we can still continue to hold on to the notion that the rate is really risk-free. So we'll be looking at about 6 areas. These are 6 very short areas to just share some perspective on what I found.
Well, Bennet, sir, I haven't seen you share your screen yet. Can you share your screen?
Okay. Oh my God.
Sorry.
So go and then share.
There we go. Thank you.
Perfect.
All right. Okay, so we're looking at about 6 areas to look at the risk-free rate, to attempt to restate what risk is within the risk-free rate, a quick view of antecedent to give us a good understanding of the origin of the risk-free rate, but most importantly, to look at application of risk-free rate in business valuation, and then how realistic it is. So what is the risk-free rate? Typically, the risk-free rate represents the return that investors get by investing in instruments or securities which are considered riskless. And typically, it will serve as a benchmark. So if an investor is taking on a risky security, you surely should be expecting to get more than what you will get if you invested in a riskless instrument. So you expect to have a minimum plus the additional risk premium that you would expect. And in finance, in business valuation, investment, and all that, we typically rely on a treasury rate and then the long-term bond rate as proxies for the risk-free rate. And the only reason is that governments are not expected to default when maturities are due. So the risk-free rate considered by investors as a rate you don't worry about because the government will always pay you. There is nothing like non-payment maturity. What is risk then within the risk-free rate? Risk is all about uncertainty, the possibility that an expected outcome will not be realized, or an expectation or a situation where reality will fall short of expectation at the time of investment. Now, what is important for us to consider in business valuation and also in finance is that it is about the uncertainty that a payment or a return will not be fulfilled at maturity. It is not the actual occurrence of the event. So in building risk into an analysis, it is a consideration that potentially the expectation will not be met, for which reason one would build risk into the analysis. So where does it come from? An antecedent. And I'll just do a very quick recap of what we all know. Now, a gentleman called Harry Markowitz, who is an American economist, introduced the concept of modern portfolio theory somewhere in 1952. And this was a major change in the landscape of investment because he focused on allocation of risk, uncertainty, and how when one diversifies a portfolio investment, the individual risk of assets within that portfolio reduces. Now, based on that, William Sharpe developed what we call the capital asset pricing model, which I'm sure any student of finance would have come across this in accounting, in investment, business valuation. You surely should have come across the capital asset pricing model. And what William Sharpe introduced is the situation that when you invest in a stock, which is considered risky, then you must have a return which is higher than the risk-free rate. So he identified two components. You should have a risk-free rate plus what he called the equity risk premium for taking on additional risk. And as far as William's theory went, he talked about the risk-free rate plus the equity risk premium. So when you tie up your investment, there is a component which is risk-free, which you should get at any cost, plus a premium based on the risk associated with additional, the compensate for the additional risk you take on a non-riskless riskless investment. There was a third gentleman, Merton Miller, who picked up the modern portfolio theory and eventually came up with what we call the cost of capital. And according to the theory, the value of a business is determined by the present value of future earnings, which is very important in business valuation. So the three gentlemen eventually made significant contribution to finance, to investment, to business valuation, and accounting, and the like. And they were recognized by the Nobel Prize in Economics in 1992. And what the committee said was that the modern portfolio theory was the biggest thing, the first biggest thing that happened in the field of finance and the financial economics. And they went on to say that the second biggest thing that happened in the field of financial economics is the capital asset pricing model, which changed the way financial economics, economic theory, corporate finance, and the like evolved to this day. So how do we apply the concept of risk-free in business valuation? There are two areas: the computation of the capitalization rate, the discount rate, or both. And as we all know, the discount rate is the rate of return that we use to discount future cash flow to present value. And in business valuation, we typically use the weighted average cost of capital, which factors in the capital structure that we use to discount future cash flows to determine the fair market value of a business, part of a business, interest in the business, shares or share value, intangible assets, or others. And this is how we represent the discount rate. There's a risk-free element, which is the RX. RX is made up of the risk-free element, which is the risk-free rate plus the beta multiplied by the market risk premium, which together will be the equity risk premium. So this is directly from the capital asset pricing model. And there are some thoughts that the CAPM as it stands is for valuing large companies that are liquid and the rest. So if you have to apply it to small companies, private companies, there's a need to make adjustment to this. Okay. And then the second application of the risk-free rate is in the area of estimating the capitalization rate, which we use to discount a single period income to value. So single period earnings will be converted using the capitalization rate. And if you look at the capitalization rate, it also starts with the risk-free rate plus the equity risk premium, specific industry risk premium, specific entity premium, less the average growth rate. And we know that if the average growth rate is 0, then the discount rate and then the capitalization rate are likely to be the same. So the question that really hit me when I observed this is that, does it mean when the risk-free rate is impaired, then we can't apply methods under the income approach because the discount rate relies on risk-free rates and capitalization rate also rely on same as a starting point. So does it also mean that if there is no risk-free rate, we cannot apply methods under the income approach? So how realistic is a risk-free rate? One big assumption I found is the certainty of payment. When you buy government treasuries or long-term bonds, at maturity, you'll be paid timely, you'll be paid without restructuring, you'll be paid without default, there'll be no impairment of your expected return and your principal. So when that certainty of payment is eroded, the question that arises is, should we factor in the risk element into the risk-free rate? Because any act that threatens the ability of government to redeem treasuries and bonds at maturity will be undermining the risk-free rate. Now, recent developments in the world have questioned the fundamental assumption and notion that there is a rate which is risk-free. And as Wolfgang mentioned from the beginning, all over the world, jurisdictions, countries, economies, the profile of risk has increased over the years. The frequency of major shocks has increased and is more frequent than it used to be, let's say 50 years ago. The past 20 years has seen significant turbulence in the world economic and financial system. And as a result of that, governments are increasingly defaulting to fulfill their payments on trade bills and also on long-term bonds. So if you look at it critically, as if the past 20 years marks a tipping point where the risk-free rate is increasingly losing its universal application. So governments have rescheduled payments at maturity. Governments have deferred payments. Governments have been renegotiating rates. Government have been paying interest and investments. There are instances of non-payment, and there are also haircuts, not only of interest. You lose your interest, and in addition to that, your principal is impaired. It could be a combination of these or all of these. So check some countries, and I tell you there are a bit more countries today that between 2002 and 2023, Argentina has seen up to 75% impairment of treasury returns or return on bonds. During the financial crisis, Greece had some difficulties which still pertain, and there was up to 50% impairment of expected returns. Investors lost money. Barbados and Jamaica were significantly hit in the financial crisis of 2008, 2009, and they are just around 40% of impairment of returns. Sri Lanka in 2022 went through serious turmoil, and investors lost up to 44% of expected return. And of course, my own country, Ghana, the motherland, there was up to 75% impairment of return. And there are instances where repayment have been stretched for the next 15 years. The rates have been reduced significantly. So there is significant evidence to show that we may not be having what we call a universal risk-free rate. So I checked a couple of countries. I checked Germany because we have Wolfgang to see what has happened to long-term yields. I checked India, I checked Brazil, and I also checked on the US. And what I noticed was that Germany, India, and Brazil had very close to, let me say minor changes in the 10-year treasury bond in terms of trend over the past 20 years. Then I looked at the US, and this is what I found, that in 2018, the long-term bond rate was 2.69%. It reduced all the way to 0.93% in 2020. And then look at what happens in 2021 and then 2022. So the question I asked is, if we are thinking about adjusting the risk-free rate, what do you do in a situation like this where you see a hike in the rate over just 2 years, assuming you're conducting evaluation in 2023? What do you do to the rate? Now, because there's a direct relationship between risk and return, when the market is asking the government to pay higher on the bond, indirectly, the market is telling the government, you have become very risky, so we want you to pay more before we buy the instrument. And as at this morning, what I noticed is that the US government is just 5 days from default if the budget limit is not increased. I can tell you one thing. If you are an investor holding bond which is almost maturing and you hear this news, obviously the government, the US government is giving you high blood pressure as an individual or as a company. What that means is that the risk profile of the country, the government, has increased, and that has to be factored into a computation of what we call a risk-free rate. So what quick conclusion can we draw? One is that the global system, the world financial, the world's economic system have become riskier than before. And what we call the risk-free rate may have been risk-free at the initial stages, but they cease to be risk-free at this particular moment. And I'll tell you what had happened. Over the past 50 years, the world financial system has exploded in size to the extent that governments are able to borrow far beyond what the limit should be. So once government can borrow more than their capacity, obviously, they are exposed to risk. So that is the first thing. The second thing is that because of the frequency of occurrences, shocks, and disruptions of global system, most countries, especially those that are what we call the frontier countries, will run into problem paying because they would have taken long-term, they would have issued long-term bonds at the time of maturity when they're getting ready to pay. There is a global crisis, there is a major shock, and that shock can prevent them from fulfilling their obligation. So risk has increased, and the question is, we as business evaluators, is it not time for us to adjust the risk-free rate to ensure that the capitalization rate and then the discount rates that we apply in business valuation are realistic? So I've been looking at a new paradigm. And the new paradigm, of course, I'm showing the old where the expected risk return, RX, is made up of the risk-free rate plus the equity risk premium. And the new paradigm that I'm putting on the table is expected return is equal to what I call the safe rate plus the equity risk premium, where the safe rate is defined as the notion of risk-free minus the government risk factor, which is GR, which you see in red. And of course, the rest of the equation continues. So how would the new paradigm affect our valuations? Immediately you apply a risk profile to government risk and government risk indicator, and you reduce the risk-free rate by what we call the government risk. We are going to see higher valuations of private equity. So when we adjust the risk-free rate for risk, unless there's no risk in that particular jurisdiction, but then when there is risk element according to the analyst and the risk-free rate is adjusted, the capitalization rate and the discount rate are likely to be lower than they would have been. So what that means is that we're going to see higher valuation of private equity. So the biggest question that I ask myself, which I'm throwing to all of us, it looks like we as business evaluators significantly overrated governments. And for that reason, we underpriced private equity because we haven't factored in the risk element to what we call the risk-free rate, even though government is risky. So now, what I decided to do is that if you want to participate in sharing my views on how the risk element be computed, which I've worked on already, we will invite you to come to Fort Lauderdale, either in person or virtually, so we can reflect on how to factor government risks into what we call the risk-free rate. And what I want to believe is that if we begin to respond to the realities of the financial economic environment we live in now, we're going to provide better valuation conclusion and continue to assume that governments are riskless. So the bigger conclusion that you get from this presentation is that what we call the risk-free rate may apply in some jurisdictions, may apply in some countries, but cannot be universal because of what we have seen in terms of government's ability and the expectation of investors that government will not fail in honoring its obligations to investors at maturity. So I would like to end here and hand over to the panelists, to Wolfgang and also to Shanda. I believe there are a lot of things to discuss because I'm stirring, your thoughts on this whole concept of the risk-free rate. And then let's see what we can all share together. Thank you very, very much.
Bennet, did you see the question that's in the chat? And we also have 20 more minutes that we need to fill. So do you have any additional information that you could provide as well?
So there's a question from Tim. Is the government risk factor that is mentioned related to the default spread for country ratings, or is there any other specific way to measure these government risk factor?
Hold on. Okay, can I stop sharing? How do I stop share? Okay, let me stop. All right. So the point is that is one of the indicators that I'm factoring into how to compute the potential risk of a government in terms of its ability to honor its obligations. So government, the ratings by international rating agencies, are one of the indicators in the analysis.
Okay. But one remaining question from my side. The challenge, I believe, is to translate a country rating into a probability of default. So if you would like to reduce measurable government shield by a factor X to this risk-free rate, you have to measure the default risk for this country in a percentage figure. And I'm not sure how you would do this. So there are some suggestions in the market. I think Tim also posted one from Aswas de Moderan. So what is your idea how to measure these this deduction, this government risk factor?
All right, thank you very much, Wolfgang. So I considered the ratings, and I actually consulted my members, the membership of AACBA, to share some thoughts. And I felt that would be very difficult. So one of the things that I'm taking into consideration is the size of government borrowing. Now you look at the size of borrowing versus the GDP, which can be measured across the globe. And then in addition to that, of course, I want to share this for Laura, we are putting the cart before the horse. Yeah, so I'll just give snippets. The other thing is to look at the risk of government in the past 5 years. An example is the US government, that you buy an instrument 10 years ago, just at the time of maturity, you begin to see a rise in government risk. So there's a way I've come up with some suggestions how to factor that to apply to the government risk. So one is to look at the borrowing rate to GDP, which will give you an indication, but it should more be market driven, where you're looking at how the market is perceiving the government in the past 5 years, and then use that as a basis to determine the risk factor.
Okay. There's another question. There's a second point from Michael Guthammer. You have shown the development of the US government yields, 10-year bond yields. And it is obvious that over the last 24 months, very much of this increase is driven by inflation or inflation expectation, to be more concrete. So the increase in government rate bonds is not only the increase in risk. So you have to separate the portion which is driven by inflation, I think. And I think that's also the question of Michael.
Yes, thank you very much. 100% I agree with you, Michael. But then if you look at the bigger picture, the government of Ghana defaulted, and they are attributing this to COVID and disruption of supply chains and all that. And then of course, there's also a big factor, which is the Russian-Ukraine war. My question is, for you as an investor, you're looking at the capacity of government to pay you. So you could work out what makes up that. Now, when you take inflation, for instance, I think inflation has got to do with management of the economy. So when there are shocks and the government, think about it. In 2020, at the peak of inflation, at the peak of COVID, the rate dropped from
We lose Bennet.
2.69% in 20. So I understand the question to decipher which percentage you are. I don't think I have all the answers now, but what I want to believe is that there's always a big picture, which is how the government is seen by investors. And depending on the appreciation of the behavior of government, they'll be asking for more. Think about it. What do you think will happen if the German government is about 5 days from default, or any other country, and then you give that different reason for why the government is in that situation? Obviously, when people are going to invest
Bennett, sorry to interrupt. I think we're getting
in
some
government
bandwidth issues.
bonds, after that, they'll be acting. So I understand the question.
Hello, Bennett. You're cutting out, so what I'm going to recommend is if we stop your video share just to save some bandwidth, and that way you get capture your audio instead. Hopefully that would help.
Are you there, Wolfgang? Yes.
Bennett, can you hear me?
I'm here. I lost you. Go ahead.
Okay. There is another question from Elsie. Do we have a measure if you would decide if a company or a country should be considered as risk-free, or you should consider your government risk factor? Do you have a measure where you decide for these countries you would not deduct a government risk factor, and for other countries you would deduct it?
So the point again is that before I got to this point, I tried 3 countries beyond the US, and I looked at Germany, I looked at Brazil, and I looked at India. And the point I made is that when you look at what has happened to treasuries and bonds in the past 10 years, they seem to be stable along a certain percent. So there might be minor risk element. But what I said also is that there could be a reality check where your starting point is to check the capacity or the government borrowing. If government has borrowed 95% at the time you're doing the valuation, that obviously poses a risk. Some countries have borrowed over 100% of their GDP. All those countries are in trouble. So there's a reality check where you can check and say, okay, this country has borrowed 50% of GDP, which is not a risk, compared to a country that has borrowed 90%, 95%, 75% of GDP. But again, the measure is going to be what has happened in the past 5 years, how the market is looking at the government, because your maturities are more related to the current situation than 10 years ago, 20 years ago, when you were buying the instrument.
Yeah. One question from my side. Have you thought about looking to credit default swaps on government bonds? So there is a price for protection of the default of the country. So maybe it makes sense to look at these credit default swaps and try to turn these prices into a default rate or something else.
And thank you very much, Wolfgang. 100% agree with you. It's one of the indicators. Because in Ghana, for instance, the government has issued a lot of international bonds, Euro bonds. It used to be 3%. It increased, and today, at one point, was 8.5%. And it's gone into the roof. And it has got to do with the insurance, the security, and all these things that go with the protection of the investor. So 100% I agree with you.
Yeah, there's one comment from Tim again. Now in the US, the government has a ceiling on the financial budget that they can spend, and this ceiling is not raised. The government of the US has to shut down. Should this impact the risk-free rate, in your opinion? And if so, how?
I just pray the US government does not default in the next 5 days, because it will be tragic. It does. Yes.
Okay. Okay. I have another point which I cannot fully agree with you, Bennet. Your conclusion at the very end was
because for more than 400 years, the United States, and if the ceiling.
Bennet, can you hear me?
Yes, I can hear you.
Okay. Okay. My thought was on the technique of capital asset pricing model and splitting total returns into market risk premium and risk-free rate. And you said that it makes sense to think about the free of the risk-free rate and maybe to deduct a risk factor from the risk-free rate. But then you concluded that the market risk premium should stay the same, and then the total return would reduce in the same way, which leads to higher valuation of companies. And I'm not sure if this is the way, because it could also be that if the risk-free rate from a theoretical point of view would be lower, then the market risk premium could be higher than in the early days. So it might be that in a nominal or real world, maybe more realistic in a real world, that the total return from an investor's perspective could be more or less stable.
Thank you very much, Wolfgang. And the point you have made may be true. The point I'm raising, and I want all of us to think about, is we've held a certain rate for free for all these years. It may have been true from the beginning when the world financial system was not as complicated and big as it is, where countries could not overborrow and all that. So you may be right. The first step is look at what we call the risk-free, and that is from my perspective, whether it's really risk-free. And then once that is resolved, we can go back and say, okay, what about equity risk premium? Is that something that could be done? Because the challenge teaching finance to the current generation is to be propounding this theory of risk-free when we can't answer questions of government defaulting. So even if it is risk-free, the argument and then the point I'm making is that it may not be universal. The risk could be zero in some countries, so the rate can apply the way it is. But in some countries, there will be the need to deduct a risk element. So I agree with you. This is just the first stage, and obviously the second stage will be something that could be looked at.
Okay. There is another comment from Michael. I think that in your analysis, you need to distinguish between countries that have only debt only or mostly in their own currency versus countries that have foreign currency debt. If only local currency debt, it is hard to get to a default situation, bearing political issues, of course. So he suggested that you distinguish for countries who have debt in own currency or in foreign currency.
Thank you very much, Michael, and I appreciate this point. And that is something that is part of the analysis. What we found was that using Ghana as an example, the government borrowed locally, the government issued international notes, and the government defaulted on the local and defaulted on the international. So it's always important to separate the two. So that is part of the analysis.
Okay. There's a question from Babatundi. How effective is the use of default spreads if we are valuing in local currency? Do you have a note on this? How effective is the use of default spreads if we are valuing in local currency?
Babatunde, thank you very much. I understand this question. We always need to find a way to move from the local currency to an important currency like the USD, so we can have comparatives. Just like we do business valuation USD in Ghana, and you have to use the international Kpentey. I'm sure there's a way around that. I haven't really gone into that yet, but it's one of the things that we need to do, how to move from a local default situation and the international comparison. And the thing is that when government borrow internationally and the currency, local currency is not stable, they actually run a higher risk of default, because when there's significant depreciation of the local currency, which has been one of the problems that Ghana faced, it was almost over 50% depreciation of the currency. The amount of foreign debt doubled and it became impossible for the government to pay. So it's a good point and something that one has to think through carefully and then get a solution.
Okay. So I run through the questions. Here's our last attendees check. So, interesting discussion. And if I'm right, Bennet, you are still on the research path of this experience, and you will have some more information and some more results on your research in December, I think.
That is true, and obviously the feedback I'm getting from the webinar today is very helpful. So I will reflect as I continue with the research and then see what else I can bring to the table, so we can all reflect on this together and see whether there's a need for us to begin to factor or consider a risk factor in terms of how government behave to their commitments.
Yeah, I believe there are two very challenging topics for me. One is this from a European perspective. So I've never had the challenge to value a company in Ghana, Bennet. That's definitely easier in Germany, but I think if German valuators discuss about country risk, it's a totally different discussion than you have in Africa. And we have now the challenge in Europe with this inflation, but we hope that the German government bonds are risk-free. But to be honest, there are credit default swaps measurable. So the capital market is not 100% sure if the German government bonds are totally risk-free. But to be honest, in Africa, it's definitely this is another topic. This is another dimension of topic, and so I would take care on the relation between inflation and real growth or real risk in these government shields. And the second topic for me, and the second challenge, is if you decide to adjust such capital information like a risk-free rate, you have also think about the equity risk premium, because all the studies calculating equity risk premiums historically or implied equity risk premiums, they use their own definition of risk-free rate, and this should fit together to the risk-free rate evaluator uses in this concrete valuation, that you do not mix up two components which does not fit together. So I think that's a challenge in praxis to find a balance between the true risk-free rate, but also to the true equity risk premium, which fits to your assumption on the risk-free rate. That is definitely
I would say the point is well made. So I'll reflect on that and then see what I find, especially the relationship between the risk-free rate and also the equity risk premium. Because what you don't want to overlook is, what if when you adjust the risk-free rate, the equity risk premium goes up? So at the end of it all, there's a balance in terms of what is considered the expected return. So I will take a look at that. Is it possible for any of our American, Shanda, and your American, a practitioner, to share some thought on how free they consider the US bond rate? I mean, in the midst of what is happening.
So you are asking Chanda if they could make such a survey or something like this?
No, I'm just asking, how do people feel about it from the valuation community? Is there a topic that has ever come up?
Okay. In the US?
Is Michael there? Can Michael share some thoughts?
I think Chanda lost internet, so.
Okay.
Okay. Interesting discussion. I got in touch with this discussion the first time. I think it's three years ago, where we had these very, very low US interest rates, 0.93 or something like this, and we asked the bonds, I think for I don't know, Apple bonds or something else, were more attractive to use as a risk-free rate for the US than the US government bonds. So this was the first time I heard about the discussion that government bonds are maybe not the perfect representative for a risk-free rate. But I believe we should stay with the governments. But to be honest, maybe it makes sense to think deeper. Yeah, Kroll mentioned note from Michael. Yes, Kroll calculates normalized rates. I'm not sure that I agree with a normalized approach. So that's Michael, but that's definitely also my view. I have not a very good gut feeling if somebody normalizes real prices from the capital market. Yeah, but yeah, there are some consultants in the world who normalize. In Germany, for example, it would not be acceptable to normalize risk-free rates. Yeah, so if the spot rate is 2.5%, you have to use the spot rate of 2.5% for euro cash flows. and you cannot normalize it to 3.0 or something else. No way in Germany to defend it. But different countries, different rules, different behaviors. Be careful that you stay in your decisions within these frameworks where you can defend your assumptions. And it's definitely different from Europe to Africa and from Africa to the US. Okay, thank you everybody for this interesting discussion on this. I think it's an interesting point where we can dive deeper. The next, thank you, Bennet, for your thoughts. And I'm happy to see you in Fort Lauderdale in December.
Thank you very much. Thank you.
Was a long time ago. Our next Around the Valuation World show will be in 4 weeks. And we will also talk about cost of capital, but overall on the cost of capital, there's a lot of empirical research on cost of capital. And we have invited Professor Nyberg from Finland. He has produced a very deep empirical studies on long-term developments of cost of capital in industries or for peer groups and companies. So it's an interesting dive into the overall cost of capital discussion. Yeah, thank you for joining us. Thank you, Bennet, for your input, and take care and see you in 4